What if I told you that the biggest story in the stock market isn't about the handful of giant companies we hear about every single day? What if there's another signal, a voice from 2,000 other companies that might just be the market's most honest truth teller?
When you think about the market, I bet your mind immediately goes to a few huge world-famous names, right? Well, you're not alone. The headlines are totally dominated by them. But here's the thing. That's not the whole story. There's another one, a messier, more volatile, but you could argue a much more honest story being told. Welcome to everything you need to know about finance. Today, we are pulling back the curtain on the market's hidden truth teller, the Russell 2000 Index. Now, just a quick heads up before we really get into the weeds. This is a deep dive for informational purposes. It's not financial advice. We're just here to explore how it all works, together. And hey, if you find this kind of content interesting, do us a favor and hit that like and subscribe button. It really helps us make more of these explainers.
All right, so here's our game plan. First, we're going to uncover this other market story. Then we'll pop the hood and look at the small cap engine to see why it moves so differently. We'll find the one big trigger that acts as its master key, and then we'll learn how to read the powerful economic signals it's always sending. Finally, we'll pull it all together for the big takeaway and see what it might be telling us about what's coming next.
So let's jump right in. If you think of the S&P 500 as the story of the global giants, well, the Russell 2000 tells the story of pretty much everyone else.
So what is this thing exactly? The Russell 2000 is an index that was created way back in 1984. It takes a bigger list of 3,000 companies and just tracks the 2,000 smallest ones. It's basically the go-to benchmark for what everyone calls small cap stocks in the US.
Now, small is definitely a relative term here. The average company in this index is worth around $3.65 billion. Yeah, that sounds huge, right? But then you put it next to a multi-trillion-dollar tech giant, and suddenly it puts things in perspective. These aren't tiny startups, but they are playing in a totally different league than the titans of the S&P 500.
This slide right here really gets to the heart of it all. Think of it like this. On one side, you've got the S&P 500. That's the mega corporations, the global players defined by scale and, a sense of safety. But on the other side, you have the Russell 2000. This is Main Street America. It's got a laser focus on the U.S. domestic economy, and it's all about growth, which, of course, means it also comes with a bit more risk.
Okay, so if this is Main Street, what does that actually look like? Let's get under the hood of this small cap engine and see why its story is just so different.
Just take a look at this sector breakdown. Right away, you can see how different it is from the big tech-heavy indexes. The Russell 2000 is actually led by financials, industrials, and healthcare, sectors that are deeply, deeply woven into the fabric of the domestic U.S. economy.
This gives the index a completely different economic DNA. We're talking about regional banks, not the huge global investment firms. We're talking manufacturing and logistics companies, not software giants. And a lot of smaller biotech and pharma companies, not the massive conglomerates. This is exactly why all the AI hype that can lift the Nasdaq doesn't necessarily do a thing for the Russell 2000. It is a pure play on the U.S. economy itself.
So because these companies have such a different DNA, they react to economic forces in a totally different way. And there's one force, one master key that has a huge, outsized impact on their fate: interest rates. And the reason is actually pretty simple. These smaller companies just don't have a mountain of cash sitting on their balance sheet like an Apple or a Google does. To grow, to build a new factory or hire more people, they need to borrow money. And a lot of that debt is at a floating rate, which means when interest rates change, their borrowing costs can change almost overnight. This creates this really direct, almost mechanical cause and effect chain. The central bank cuts rates and boom, debt gets cheaper. For these smaller, growth-hungry companies, that means profits can go up, their stocks look more attractive, and the entire index tends to rally. It's really no surprise that historically, periods of falling interest rates are one of the absolute best environments for these small-cap stocks. Okay, so we know what it is, we know what makes it tick. Now for the really fascinating part, what is its performance actually telling us about the wider economy? This table, it says it all. I mean, look at those wild swings. An explosive 47% gain in 2003 coming out of a recession, a brutal 33% loss during the 2008 financial crisis, another huge 38% rally in 2013, and then a sharp 20% drop in 2022. This perfectly shows its risk-on, risk-off personality. It has massive upside when the economy is recovering, but can deliver some pretty brutal losses during a downturn.
And coming out of that volatility, the last couple of years tell a story of things kind of getting back to normal. After a really solid gain of almost 17% in 2023, the trend shows a market that's found its footing again, which reflects this broader feeling that economic growth is finally stabilizing.
And this right here, this is maybe the most critical thing to understand when you're trying to read its signals. The Russell 2000 is a leading indicator. It's not a rearview mirror telling you what just happened. It's more like a telescope trying to price in what the economy is going to look like 6 months from now. When this index starts to surge, it's a powerful sign that investors are placing some big bets on a stronger economy up ahead.
So, what does this all mean for how we should think about the market? What is the big overarching takeaway from all this?
There's this quote that a lot of market professionals basically live by. And what it means is that if only the 7 biggest tech stocks are going up, the market's strength is narrow and it's probably fragile. For a rally to be seen as truly healthy and broad-based, you need the little guys. You need the Main Street companies of the Russell 2000 to be participating too.
So this is the true identity of the Russell 2000. It's louder, its swings are way more dramatic, it's messier, its path is never a nice, clean, straight line. But you could argue it's more honest, because its performance reflects the health of 2,000 different companies, not just a handful of giants. And in that sense, it really doesn't lie.
Okay, let's wrap this up by looking ahead. Now that you're armed with all this knowledge, what should you actually be watching for?
So here's the key thing to watch. Don't just look at the Russell 2000 by itself. Watch its performance relative to the S&P 500. If you start to see the little guys consistently outperforming the giants, that's your signal. That's the sign that confidence is spreading through the whole economy, the recovery is broadening out, and investors are finally ready to take on more risk again.
And that brings us to our final question for you to think about. By watching its performance, its relationship with interest rates, and how it's doing compared to the bigger indexes, what do you think the market's honest, messy truth teller is signaling about the economy right now?
That's a question worth thinking about. I really hope this explainer has given you a powerful new lens for looking at the market, one that goes way beyond the headlines. If you enjoy digging into this with us, we have plenty more explainers on the topics that are shaping our world. Be sure to check those out. Thanks for joining us.